Welcome back to This Is Not Financial Advice. First thing right off the bat, I'm going to ask you to like the video or subscribe to the channel or both. I'd appreciate it. So recently, I had a viewer of our channel ask me to take a look at GE stock, and I was not prepared for that. So it's a very interesting question, and the question might be, what is GE worth as a company? And it's a pretty surprisingly challenging question to answer. We're going to be taking a look at the price of GE stock, talking a little bit about the history of GE stock. And this is going to be a good opportunity to sort of bring in some things I've learned about investing over the last 2.5 years, some different things about the psychology and philosophy of investing, and overall just the life cycle of a company. So we're going to start by looking at the price of GE stock. Um, some of you may have never heard of this company. In my research, I found that between the period of 2000 and 2005, GE was the largest company in the world by market cap. At that time, $500 billion. So GE is essentially an American powerhouse conglomerate at the tail end of its life, or so it seems. A name that was very common in the 50s, 60s, 70s, 80s, and 90s, and one that has, from peak to trough, lost as much as 85% of its value. And this chart that you see in front of you is the chart of a company that's dying, or a star that's burning out, in so many words. So if you didn't know, the big news about GE in 2023 is that fiscal year 2022 is going to be the last year that GE existed as an entity in the traditional sense. They are now splitting off and creating three new publicly traded companies: GE Healthcare, GE Aerospace, and GE Energy / Solar, essentially, are going to be their sort of three core components. They're going to be split out and become their own publicly traded companies. GE Healthcare is out. There are about 4 years of data that were just from the segment of GE that represent the things that they've done in the healthcare space. To my understanding, it's making large machines used in hospitals. That's really the extent of my understanding, to be frank with you. But I'd stick with me here for a second, because I think this is pretty interesting. We've also seen this recently with J&J. So J&J is spinning off their consumer packaged goods portion of their business. So J&J will be keeping their medical side, vaccines and medicines and things of that nature. But brands, such as Listerine and Band-Aid, are going to become their own company with J&J. And so this is a thing that companies do for a lot of different reasons, but let's talk more about GE in particular. The current price of GE stock is $115 a share. It's trading at a pretty low, actually it's trading at a pretty decent PE ratio of 13.7. But we can see here from the year 2000, when the price of the stock peaked, to uh, 6 or 7 months after the pandemic started, the stock had declined as much as about 89%. Okay. And so this is point number one, which is the risk of owning individual companies. So it's a broad oversimplification, but the more risk you take on, the more reward you may gain. And that can be true. In the case of someone who bought a lot of GE stock in the year 2000, that would have not been the case. So first concept we're talking about is single stock or single company risk. You can be familiar with the company. You can have an understanding of what the company does. You can think that the price of the stock seems reasonable. You can feel comfortable with the company, and you can invest in it And it may be that it's the right company, but you're too early or you're too late. And that can be the same thing as being wrong. And, every company, like a person, has a life cycle rather, from infancy to childhood years, teenage years, adolescence, young adult, adult years, middle age. A company can have the properties and characteristics of someone who's around 50 or 60 years old. That might be a company like Home Depot or Coca-Cola. And then you can have companies that are geriatric in nature, like GE, starts with G. It's a company that is, literally and metaphorically over 100 years old, and it's at the end of its life cycle. And this is what a stock chart looks like when you're seeing that. But I think the question or the interest in the stock is going to be, how did a stock go down almost 90% from 2000 to 2023, but this year it's gained 75%? So, this is the type of chart you'd expect to see on a Tesla or an Nvidia, a hyper growth company. So what is the actual worth of GE stock? Let's take a look over at Qualtrum. Note on Qualtrum, it's a piece of software that I pay for to analyze stocks, yet I have no affiliation with Qualtrum. So I'm going to leave a link for Qualtrum in the description below. And we're going to just sort of see some of the financial performance in the last years of GE and what that's looked like. So let's take a look at the revenue of GE, which in the last 20 years has essentially been composed of these three components: healthcare, aerospace, airplanes, things of this nature, and then also energy, as well as solar more recently. So we can see that the revenue for the company, we saw earlier the stock price started to decline pretty heavily after 2005, yet the revenue did go up for several years after that. But you can see this lifetime chart of GE's revenue that very much looks like their price chart of their stock. It also looks like the arc or the trajectory of the life of a human being. And so this is a company that's in decline. That's pretty much that. If you wanted to get an answer to what the value of GE stock is, you'd need to break out the three component parts. The data isn't immediately available to me, and a lot of the data doesn't go back far enough. I think, in the case of the GE Healthcare brand, they've given us 4 years of data, um, and they're just essentially shares and free cash flow. They're just pretty much even lines, and it's something that they've probably had in the works that they're going to split these companies off, and so it's almost like a prepackaged thing. And what I guess this will get us to point number two. And a side note on that, if you want to value GE, you would probably have to resurrect um, Warren Buffett's mentor, Ben Graham, the father of modern value investing. The truth of the matter is, the value of GE's stock based on free cash flow is nothing. So their average free cash flow in the last 5 years is about negative $5 billion. They have a lot of debt. So there's more than one way to value a company. And there are only a few ways that I feel comfortable with. I predominantly feel comfortable with rudimentary discounted cash flow valuation. So how do you value a company that does not produce free cash flow? Ben Graham, 30s and 40s and 50s, would be maybe happy to see a company that was trading for 1 times its tangible assets. So if all of your factories and assembly lines and machinery and vehicles and your trademarks and your logo and your branding, if that's all worth $800 million and the market cap of or say back in the day, that's all worth $8 million and the market cap of your company is currently trading at $8 million, deep value investors have been happy in the past to give someone dollar for dollar, cutthroat, a 1 or a 1.0 1x multiple on your tangible assets. And so that's the value. And that would be probably, to my understanding, the way to value GE, but it's not really helpful or instructive. So they don't produce free cash flow. Let's see how much debt they have. Less than the past. Oh my goodness. So we can see here on Qualtrum, I said less than in the past. They still have $21 billion in debt. So in in 2012, when their stock price was this is when the stock price was making rapid declines. They had some good revenue in these years, but they had at one point $414 billion of debt back in 2012. So again, we're looking at the lifespan of a dying company. And that's the second part, is that at a certain point, a company is just worth the sum of its parts. So now we'll get to the third part. It looks like they've had dividends that were higher in the past. They've suspended them as they're breaking these companies up into three parts. And the third part of, having this conversation or discussing why is the stock up 75% year to date is, why would a company split itself up into multiple segments? And so that's something I also don't feel super confident about, but I have a few ideas. If you're appreciating the honesty, like and subscribe to my channel. Like the video, subscribe to the channel. I appreciate it. But I think from the perspective of the people on GE's board, if you can split out different businesses. So one of the benefits right away is GE now has a healthcare business with its own ticker symbol. It's its own entity as of right now. That company will be swept up in passively managed index funds. So healthcare ETFs will likely start to buy shares of GE Healthcare. Additionally, GE Aerospace shares will likely start to be picked up by the index passively in ETFs within the aerospace and defense sector. I'm not sure if it's happened yet. I haven't looked, but in the future, it already may have, or it would be added to Spider's XAR, Aerospace and Defense ETF. So splitting up the company into three branches. Additionally, the energy company could be added to energy sector ETFs. So right off the bat, when you split an old dying conglomerate into multiple pieces, in essence, what they're doing is the same thing that Ben Graham would have done. Is they're basically selling themselves off for the sum of their parts. And so I think the price of the stock going up so much is that, there are going to be elements of GE's business which are going to be more or less attractive. I just so happen to like the healthcare space, but it may be, and I didn't look because I couldn't do it justice in this amount of time to sort of give an honest take on GE stock. But it could be that the aerospace and defense is their highest margin business, and the energy business is a very low margin business and has a lot of debt. And so there's going to be different characteristics and different multiples. Some of their segments are going to be growing faster and be able to reinvest in themselves more profitably. They'll be re-rated with a higher PE ratio. So in splitting the company up, they can attract new, there'll be ways to say who is responsible for what debt. So, this is a bit of speculation because it's a bit above my head, but in splitting the companies up, in some way, you're splitting the debt up as well. And so that may affect the company's ability to have a better credit rating and take on new debt. There may be sectors or segments of the business that have higher growth trajectories, all the things that I've just mentioned. And so those are the benefits to GE to survive, is that they're splitting themselves up into three different companies. And so the question is, and what I think I think very few people understand this. And there are very few investors that watch finance videos on YouTube that are going to fully understand both the energy side of GE's business, the healthcare side of GE's business, and the aeronautics side of GE's business. And so, frankly, if you don't understand each and every one of those areas in the same way you can understand McDonald's or in the same way you can understand Netflix, don't buy the stock. People are buying the stock because what's likely to happen when all is said and done over the next few years, if you're a record stockholder of record of a certain date, you'll be given the option to split your holdings between the three companies or the remaining two that are yet to go public at this point, I guess. And then the speculation is because of all the other unknown variables, one of them could do really well. So, what is GE stock worth? I don't know. I don't have an ability to understand this company. Most people probably don't, and I wouldn't buy it. Uh, in 10 years, could one of the split offs from this conglomerate be a great company and become a top 25 holding and or top 50 holding in the S&P 500? Maybe. But in this case, going back to lesson number one, understand the life cycle of the company you're investing in. And if you're unsure, take your exposure to it like medicine through exposure to the index. All right. Like the video on your way out. Thanks for tuning in, and I will catch you on the next one.